Is it possible for Tesla stock to hit all-time highs again in the current situation? If so, how will they go about doing that? When should I make a purchase? We'll go deep into Tesla's most recent innovations in this video, covering everything from their revolutionary battery storage and residual solar solutions to their audacious aspirations for humanoid robots. So get your popcorn, settle in, and follow us as we investigate the fascinating world of Tesla and the direction that sustainable transportation is taking. Please remember to like this video and subscribe to Tesla Stock News before continuing. Unexpectedly, the business declared that it would not allow its automotive division's gross margin to drop below 20%. But when they failed to meet this goal in the first quarter, reality set in. Although Tesla had promised investors that they would keep this margin for the entire year, it is anticipated that the margin would drop much more in light of recent price reductions. The severity of the issue raised serious concerns. Tesla's performance disproved the theory held by some that decreasing commodity prices would neutralize the effect of the price reductions. Not only did they miss their forecast, but they also did not live up to the expectations of the market. Consequently, investors became apprehensive when Tesla's stock declined. It is important to take into account the advice of renowned stock analyst Dave Ives before making any snap decisions. Dave provided insightful information that may influence one's decision-making process. Now that we're talking about Tesla, this sounds like a scenario that requires more than a cappuccino to address. Well, Tesla has been going through some difficult times lately. 6 price cuts have put the company under pressure, and it is currently battling to retain profits or increase unit sales. Even while the stock started to recover earlier this year, it now needs to prove China that it can develop sustainably. For Tesla, it will need careful balancing to navigate through the current pricing war and achieve a gross profit in the range of 20%, excluding credits. Even though I think the stock is cheap, the second half of the year will need to show otherwise. It is anticipated that Tesla's profit margin would continue to decline over the next several months. The fact is that Tesla might not turn a profit this year that investors had anticipated, despite the high hopes of many Tesla bulls. Still, there are a few promising developments to be excited about. If all goes according to plan, Tesla's stock may rise above $300 once more. What has to happen in order for the company to do this, and how will it do so? Let's investigate this more. Given the recent price reductions, some Wall Street analysts are worried that Tesla's profit edge may be eroding. Even though the corporation raised pricing earlier this month in the US, it did so after a string of price cuts that were implemented worldwide at the start of the year. Notwithstanding this circumstance, investors ought to consider the wider picture. In order to reach the mass market, Tesla wants to save operating costs and give those savings to customers. Through market share maximization and scale efficiencies, Tesla may be able to save a substantial amount of money in the road. Investors might profit from this approach significantly more than from a low-volume, high-margin business. Thus, holding on to optimism for the car company might be the best course of action. Whether Tesla's stock can hit all-time highs once more is the unanswered question, even though there are some doubts, given the company's strategic orientation, emphasis on cost reduction, and goals for market expansion. It is not completely implausible. We'll see if Tesla can overcome its obstacles and raise its stock to all-time highs as the future develops. In case you haven't noticed, Tesla stock has been declining noticeably. However, astute investors have noticed this downward trend and see a chance to investigate the company's other groundbreaking technology advancements outside of electric automobiles. The price at which Tesla stock is currently trading, far less than its worth only a few years ago, is even more alluring. Currently, the price-to-earnings P/E ratio of Tesla stock is approximately 45, while the P/E ratio of the overall stock market is 19.2. Compared to Tesla's peak P/E ratio of over 1,000 in 2021, this represents a considerable decline. There is still a lot of optimism over Tesla's potential, despite the skepticism of some investors and analysts. Not everyone, though, feels the same way. The stock moved recently in response to a statement issued by JM Investments investor director Mark Horton. Horton boldly predicted that the price of Tesla shares will never again hit $300. He ascribed this forecast to the company's EV pricing reductions and expected all. There are several variables that could affect Tesla's performance. A recession, growing interest rates, and inflation worries have all had a negative impact on the economy as a whole. But even with these difficulties, the carmaker is benefiting from a number of favorable factors. Tesla's profit margins are one of its most distinctive features. They typically exceed those of its industry rivals. The business brought in an astounding $81.5 billion in revenue in 2021, which translated into $13.7 billion in operating profits and a 16.8% margin. When compared to significant U.S. competitors like Ford and General Motors, whose margins are usually in the single digits, this is noticeably greater. The remarkable profitability of Tesla can be attributed to a few important elements. First off, there is no longer a need for significant advertising and promotion costs because of the company's considerable brand recognition. Furthermore, Tesla's management has effectively incorporated vertical integration and manufacturing economies, enabling in-house battery production and direct-to-consumer sales. The corporation has seen increased margins and significant earnings as a result of these calculated actions. In addition to becoming a significant force in the auto sector, Tesla is also setting the standard for software that uses artificial intelligence to drive itself. With this cutting-edge technology, Tesla will be ready to enter the autonomous ride-hailing market by 2024. According to early investments made by ARK Invest, autonomous vehicles may bring in a new era of ride-hailing, with a potential market value of $14 trillion by 2027. This serves to further solidify Tesla's standing as a formidable innovator. Tesla keeps moving forward in the residential market by offering battery storage and solar energy options for households. In the first quarter, there was a remarkable 360% increase in battery storage capacity deployed compared to the previous year, indicating a rise in demand for these goods. With time, Tesla's production capacity has increased to match the demand, enabling them to satisfy the expanding demands of the market. Furthermore, Tesla intends to launch Optimus, a humanoid robot, in 2027. This robot is intended to be used in low-skilled occupations, mainly in manufacturing. Since there are many opportunities in the electric vehicle sector, investing in Tesla stock is a desirable long-term strategy. It is anticipated that operating costs would drop as more electric vehicle manufacturers reach scale, increasing sales. Global production of electric vehicles is expected to climb from 7.8 million units in 2022 to 60 million units in 2027, reflecting an outstanding compound annual growth rate of 50%, according to projections by ARK Invest Management. This growth rate coincidentally matches Tesla's projected output levels. Electric car charging times have decreased dramatically over time. Tesla points out that charging an electric car for a 200-mile drive now only takes 15 minutes, compared to about 40 minutes 4 years ago. Furthermore, within the next 5 years, Tesla hopes to cut this charging time down to just 4 minutes. These developments help make electric vehicles more widely used. Although just 10% of new cars sold in 2022 were electric, Goldman Sachs predicts that percentage to reach 61% by 2024. Even though it faces competition from unprofitable rivals like Lucid and Rivian Automotive, Tesla manages to deter future threats by maintaining low prices. By prioritizing long-term market share over short-term profit, Tesla hopes to become a major force in the rapidly changing electric vehicle market. Given that both the US and European governments intend to outlaw the sale of gasoline and diesel vehicles by 2035, these plans significantly enhance Tesla's development possibilities. Electric vehicles are becoming more convenient and enticing due to rising petrol prices. Tesla has addressed its environmental impact and is aware of it. According to Tesla's most recent impact report, 27% of its carbon emissions in 2022 came from the production of batteries and mineral extraction. Steel made up 8% of emissions, while aluminum utilization was responsible for 18%. The use of Tesla vehicles, employee commuting, business travel, and downstream transit and distribution account for the remaining 47% of emissions. This is the first time that the supply chain emissions have been reported by the corporation. The lifetime emissions of conventional cars much outweigh those of electric vehicles, even though supply networks for electric vehicles now emit more emissions than those of gas-powered vehicles. According to Tesla's estimations, electric vehicles release 55 tons less CO2 over their lifetime than conventional automobiles, which continue to burn gasoline for the duration of their average lifespan of 17 years.